Welcome to the Barometer Readings Monthly Conference Call. My name is Adrienne, and I'll be your operator for today's call. At this time, all participants are in a listen-only mode. Later, we'll conduct a question-and-answer session. Please note that this call is being recorded. I'll now turn the call over to Sarah Petoskey. Sarah, you may begin.
Hi, everyone. Sarah Petoskey here. Thank you for taking the time to join us on the call today. Since our last call, rate moves and Bernanke's speech regarding monetary policy have been big drivers of volatility, and markets have consolidated. The 100 basis point move in the 10-year Treasury yield since May 1st has been considerable, but we have seen similar moves like this before. Our tactical investment process, nimbleness, and the geographic flexibility of our mandates allow us to respond to these changes and protect capital. The pricing effect in the bond market has been considerable, with 10-year and 20-year Treasury bonds off -14 to -18% year-to-date. Equity markets are largely negative across the world, with very few exceptions. In this backdrop, the Barometer approach is ideally suited, with all 6 mandates holding on to positive gains year-to-date as of yesterday's close, which I will highlight. The Barometer Income Advantage Fund up 3.9%. High Income Pool, approximately 2%. The Global Tactical Balance Pool, 4% year-to-date. The Global Equity Pool, 4.7%. Our Equity Pool, 6.8%. Our Tactical ETF Pool, 9.5%. And the Long Short, up 13.1%. Joining us on the call is David Burrows, President and Chief Investment Strategist. David will elaborate on the portfolio shifts during this recent period of market volatility and speak to new leadership opportunities we are seeing within the global markets. With that, I'll pass it over to Dave.
Thanks, Sarah. And thanks, everybody, for taking the time today. I'm actually surprised you're not all on the golf course, given watching paint dry today. What I thought I'd do is talk a little bit about this backup in yields, what we think it means in the portfolios, talk a little bit about the perceived risks going forward when it comes to interest rates and some of the things that are happening in equity markets, and then maybe talk a little bit about how we're positioned. Let me start out with the obvious. In the last few weeks, certainly there has been a little bit of upheaval in capital markets. Invariably, there are all kinds of folks who like to focus on trying to call turning points. And I think that if I look back over the last 30 years of a secular bull market and interest rates, there have been lots of people who have liked to try and call the turn, only to wind up being roadkill. The fact is we have to look for the big moves, not the small ones. And while the move over the last few weeks seems to be a big deal, it really is not any different than any of the other cyclical rises in rates we've seen going back to 1980, but we'll talk a little bit about that. As a reminder, we basically try and set up any of our mandates to be tactical, to have really open mandates, give us a lot of flexibility, because you never know when you're going to need it. And certainly, we're going through one of those periods where there are some changes taking place, and we've been certainly busy. Our trading desk has been active. Over the last few years, a lot of money's worked its way into the bond market. A lot of money's worked its way into bond mandates, very specific mandates with very specific targets as far as asset allocation go. And when we set up the income mandate to begin with, the goal was, first of all, give us more wiggle room than just be focused in equities, which is what we had been focused in up till 2000. And then second, give us a range of asset classes and sectors and geographic regions that we could target. And we are using all of those things right now in the portfolios. So as many of you know, we have seen a pretty good size backup in the 10-year and the 20-year bond, 30-year bond. I think it's interesting. If you go back 1 year from July the 3rd of last year, we've had roughly a 12% backup in the 10-year in the 20-year bond. So down 12% over that period. High Income Pool in the same period plus 8%. And a lot of that has to do with the flexibility that we've had to focus on things that have some pricing power and that can actually benefit in a rising rate environment. And certainly, we're sort of there now. If you take that from the beginning of the year, I think the total return on the TLT is -9 or 10. I think we're +2 to 4 in the income mandates over the same period of time. And if you just look at the period from April, you've got about an 11% backup given the rally you've seen this week. So, how do you manage your way through that? This makes it the ninth period since the beginning of the mandate where we've had anywhere from 0.5% to 1.5% increase in long-term interest rates, where we've been able to generate sort of a positive result. And it hasn't been sort of sitting in the stuff that we've got. You've got to make changes along the way. So what I want to talk about is not so much what's worked maybe over the last while, but maybe talk a little bit about the likelihood of a backup not from 1.5 to 2.5, but the likelihood of a backup from 1.5 to 5, which we've said before would probably pose a problem in the event that it happened in a hurry. Now, of course, we do have the option of going to cash, and certainly we do have some cash in the portfolios as we speak right now, and we've got very low duration overall. I think the duration of our portfolio is about 4 years. On the corporate debt, certainly we don't have to have a lot of fixed income. We only have about 11% fixed income in the portfolio today. And in fact, that's where we were at the end of May, having come down from about 22% at the beginning of the year, just with the view that the spreads were not significant enough to give us much cushion. But let's just talk about interest rates for a minute. There's two things that have kept the rate structure where it is. In the short end, you've had the Fed, issuing policy basically at close to 0% interest rates, and then along the way they got involved in the long end by initiating QE, and that took the long end down to 1.5%. So the two pieces we have to look at is what would it take for those rates to move substantially from here. Now, the Fed's dual mandate, as we know, is jobs. They're looking for full employment, and inflation. So let's take them apart piece by piece. If you take a look at the jobs required to hit their 6.5% target rate, the number of jobs per month they need to get, at the current rate of between 200 and 210,000 jobs, it takes anywhere from takes to either 2016 or 2017 to get to their targeted 6.5% unemployment rate, and that is without consideration of those that might come back into the workforce that are not looking for jobs today, given the outlook. So certainly, getting close to their unemployment targets in the near term is not something that stands out. When we look at the jobs numbers, they're basically coming in pretty steady at an anemic growth rate. It's certainly not the wages that are attached to those jobs, because I've got a chart, and if anybody would like any of these charts, we can certainly provide them. I have a chart of the year-over-year change in average hourly earnings in the U.S., and if you go back to the late 80s, average was about 3.2% a year. Highs were around 4%. We're sitting at about 1.7, 1.8%, which is almost 2 standard deviations below the norm. So it's not job growth that's going to cause it. It's not wage growth that's going to cause it. So let's look at the inflation picture. We've got some very good charts from Statistics Canada that look at the consumer price index or the inflation rate in all the major countries around the world. And interestingly, that in virtually every country that has an inflation target range for their central bank, in virtually every one of those countries, inflation is not only below target, but it's moving lower. So it's very hard to see how inflation can be the big concern, certainly in the near term, and these things can change, but there certainly appears to be no inflation in the system, and that would make sense given what we see with commodity prices really around the world and wage growth. Now, arguably, the U.S. has had the strongest economic data over the last number of months, and outside of Japan, really the strongest equity market. And I think that when we look at what's working, in our equity mandates, we spend a lot of time targeting market leadership, and what we see from a market leadership standpoint is outside of healthcare, consumer discretionary and media really are the strongest groups. And certainly the consumer discretionary stocks are being driven by an improving consumer balance sheet, both from their home prices and their debt levels. Now, we know that over the last couple of years, there's been a big tailwind driven by refinancing of mortgages. And we've got another very good chart that highlights the rate of refinancings taking place charted against the 30-year mortgage rate. And as many will know, over the last 2 months, we've taken a 30-year mortgage from 3.3% to 4.5%. And as that refinancing cost went straight up, the number of refinancings have fallen through the floor. So, we know that the Fed uses interest rates as a tool to moderate or stimulate growth, and certainly long-term mortgage rates fall into that same camp. And if you think we've had a pretty steep rise in the 30-year mortgage rate and a fall in refinancings, it's not impossible you could see some moderation in consumer spending, which is really what's been driving U.S. equity markets. So if you tie it all together, when you look at it over time, long-term interest rates are very tightly tied to GDP growth. And while certainly things aren't getting worse, they're sort of muddling along sideways in the U.S. at about a 1.8% GDP growth. Around the world, certainly Asia is not firming, it's weakening. If you look at Europe, it's not getting better, it's getting a little worse. If you look at emerging markets in general, certainly countries like Brazil and so on are weak. It's highly unlikely we see a sharp spike in GDP growth. And so really what you see is a typical situation where there are some who want to get in front of what they think might be a little stronger second half. And so let's look at what happens when you get a cyclical uptick in growth. If we go back to 1980, there have been 7 cyclical rallies in interest rates. Every one of them during an economic cycle where you had a cyclical pickup in growth rate. Now, it's important to note that every one of those pickups in yields went from had lower highs, and every one of those cyclical pickups in interest rates were between a 50 and 70% increase in interest rates off the lows. Now let's do the math. 1.5 to 2.5% falls right in the middle of that range. So the increase that we've just had is no different than any of the 6 previous cyclical rises in rates since the beginning of the bond bull market in 1980. So I know there's lots of people who would like to say, well, rates can't go any lower, they got to go a lot higher. If there isn't significant job growth, if there isn't significant GDP growth, and if there isn't inflation, those 3 things are what drive a larger increase in interest rates. You just don't see it. The last piece that would cause significantly higher rates is a big pickup in credit risk. And while certainly you've seen a backup in credit default swaps in Asia, and China in particular, and a couple of peripheral countries in Europe, there has been really nothing in North America, certainly nothing in the U.S. The corporate spreads have widened a touch, nothing like the kind of crunch conditions you had, in 8 and 9, and really not even the beginning of that. So I don't think credit risk is the issue either. So overall, certainly when you get a backup in yields, people get concerned. There's indiscriminate selling given all of the media attention. We've said for a long time we don't want to have a fixed income mandate, because certainly there wasn't much room there. A very low weight of 11% or so in corporate debt, was us speaking with our feet. But what we have been focused on is dividend growth. And certainly everything with yield attached backed up a little in the month of June and the end of May. I think that we saw that last year, we saw it the year before, and we saw it the year before that. In each case, Things stabilized after a short period of time, and you saw the revaluation of dividend-producing assets continue. Each one of those times produced a great opportunity to enter new positions. So the way we look at this is we've been preparing for this for a while. The bond weight came down. The utilities weight came down to almost nothing, with a view that we'd be able to buy some decent issues if we got to summer and we did get a yield back up. We've just purchased some Gibson Energy bonds with a 6.5% yield, which we think are very attractive. We've just put on a new position in the Choice REIT, which we think, while it doesn't have a lot of growth, at a 6.5% yield is very attractive. We have been steadily over the last 3 months ratcheting up our exposure to U.S. securities as opposed to Canada, where we think the growth rate is a little better. We had taken down our REIT exposure fairly substantially from high 20s to low teens, and specifically, had reduced retail exposure and just focused on a couple of industrial REITs where we think there's some pricing power. And really, the whole of the income portfolio, and frankly a lot of our equity portfolios, are focused in companies with relatively low payouts, where we're getting big dividend increases. So to give you a sense for where that's taking us, so far this year, roughly 90% of our holdings have given us dividend increases. So if you can pick up, close to a 5% running yield in the portfolio, in the pool, and a little bit lower than that in the fund, and get 5 to 7% dividend growth, which is frankly undershooting what we're getting right now, we think that makes it very attractive, unless you think that we are going significantly higher in interest rates. We think that there's very little evidence of that. So we've said now for a couple of years, when we do ultimately get lows in rates, we are likely to stay low and bump along the bottom for a long time. We continue to have the view that we are likely to have a range-bound bond market that is something like 1.8% to 2.75%, maybe at 3% on the top end. I think that you've had an adjustment in prices, and the question is, if you were to go sell all that stuff, where are you going to go? We've got the front end of the baby boom at 65 years old. We've got 15 years of income replacement needs coming at the market. We think you're going to continue to see revaluation. Now, what do we mean by revaluation? Sectors that go through a revaluation often have something that's changed for the better, and for a period of time, the multiple that people will pay for earnings expands. So let me give you a real simple example. If you go back to 2000 and you break the S&P up into buckets, from the lowest payout, earnings payout quintile to the highest, the companies with the lowest dividend payouts traded at the highest multiples, and the companies with the highest dividend payouts traded at the lowest multiples. That's 2000. If you looked at that today, the highest multiples in the market are for the companies with the highest payouts, and the companies with the lowest multiples are the ones with the lowest payouts. So clearly the market has been revaluing dividend-paying assets. Now, how long can it go on? Well, we've talked about the dividend payout on the S&P currently at about 32%, up from 26% 2 years ago. We talked about the period in the 1950s and 60s when you had prolonged low interest rates, the payout ratio going to 70%. 32% is a long way from 70%. And the 14 or 15 times multiple you pay today to get those dividend yields is a far cry from the 45 to 60 times earnings people paid by the end of the 60s and the Nifty 50. So, we've had a backup in yields, but I think that the demand for yield and the lack of yield-bearing opportunities will support an ongoing multiple expansion and an ongoing revaluation in this camp. So, as it stands, when we see weakness and we see deteriorating breadth, we raise a little bit of cash. So certainly, if you look at our income portfolio today, depending on whether you're looking at pool or fund, there is some cash in the portfolios. I think at the end of May there was none, 1.4%. If you look at it today, cash is about 14%, so we have some cash. We took down the REITs and the pipeline exposure, not because they're good companies, but we just thought we might want a little bit less exposure in the short run, let some of this play out. REITs make up about 10.6% of the portfolio today, where they were 17% at the end of May in the last conference call. In the last conference call, pipelines were, 25%. Today they're at 13%. Now, do we think the pipelines have yield support here? We think they look fabulous. At the end of the day, if you can get a 5% yield and dividend growth that is 4 times GDP growth, that's pretty attractive. But we take the climb seriously. We want to make sure we're not too far on any limbs. What we have increased is our healthcare exposure, primarily in the U.S., and our financials exposure, which has come from 16% to 25%. That's the biggest weight in the portfolio, and that would be a combination of U.S. banks like Wells Fargo and J.P. Morgan, insurance companies like AIG and some of the Canadian insurance companies, asset managers, and card companies. U.S. financials, we think, look a lot more attractive than Canadian financials. You look again today, Canadian banks continue to be under pressure, while the financials in the U.S. are the strongest sector in the market currently. When you look at U.S. versus Canadian holdings, U.S. holdings are about 35% of the portfolio today, and that has steadily been growing. While corporate bonds are low, you would expect that we'll be able to add a little later in the summer as issues are taking place. So, we've made quite a few moves. Financials has grown, pipelines and REITs have come down, corporate bonds were low to begin with. Telecoms is about 2.6%. They came down again this week. Really, TELUS is the only exposure that we have in that space. And we think that the premium dividend policy will continue to make that very attractive. If you look at the balance of the portfolios, the equity portfolios, really our focus has been sectors that benefit from improvement in housing and auto, consumer discretionary. Those would be our biggest exposures. If you broke it out, you've got retail, which is largely driven around things like Home Depot and Walgreens, financials, auto, things like Magna, and media, Disney, Cineplex, and so on. The other big move we've made in the equity portfolios is, as you've seen, of all the commodities, which continue to be very weak and where we have very little exposure, the one area that is showing some improvement is oil. And while some of that might be a political premium to do with what's going on in Egypt, energy, there are certain spaces that are starting to look a little bit more interesting. Now, just want to touch on that for a minute. The equity exposure is about 80% exposed in total to equities. We are roughly half focused in the U.S., and when we look at the energy exposure, we have 3-4 Canadian names, which are very specifically the low-cost producers, where they've got a natural geographic advantage. Companies like Trilogy and Tourmaline. And when you look at the U.S., there's a new play which we're very focused on in a very old field, and that's in the Permian Basin, which is largely Texas and New Mexico. And there is very interesting geology there where you've got a lot of oil locked in sand, not shale, but they're using fracking to unlock the sand. And companies like Pioneer, PXD in New York, Diamondback, which is the symbol is FANG, F-A-N-G, are big beneficiaries in that area. And if you look at the way those stocks are behaving, it's very different than the rest of the group. So we're seeing some overall improvement in energy. We're really not focused on the big Canadian names. We're focused in the U.S. and a couple of very specific geographies. And then we're focused again in the midstream energy companies in those areas. Crosstex would be a good example, XTXI. So equity portfolios are energy, largest weight, consumer discretionary at about 12, financials at about 11, media at 7%, retailing at about 7%, technology would be the next group at about 6%, And this group is just a group that has very strong balance sheets, very strong cash balances, and probably the lowest dividend payouts, but they're moving higher. Net exposure across all of our equity mandates would be about 80%. So we do have a little bit of cash there. A lot of sectors going through some deterioration, sectors that we continue to avoid, Canadian banks in particular, materials companies, gold companies, almost nothing there. So really when we look at where the returns are coming from so far in the year, it really is a have and have not market. We're very specifically targeted and with a little bit of a defensive bent in the portfolios. So I know that that's a lot, but given the current circumstances, I think that if we look at the broad exposures, developed markets as opposed to emerging markets, equities as opposed to fixed income, and developed markets, meaning specifically actually U.S. as opposed to Europe or Asia or South America, I think that we're in pretty good shape. With that, maybe I could open it up for questions.
Thank you. We'll now begin.
Let me pass it back to Sarah, because I think that this is where it's supposed to go from here.
So before questions, I'll just close up the call. The markets have clearly been more challenging and volatile in the last few months, with a number of catalysts which Dave reviewed. In this environment, the Barometer process is well suited as we continue to monitor market leadership, play defense as required, and remain nimble and tactical in our allocation. In our work and communication with advisors, we continue to highlight our transparency with these monthly calls, our weekly holdings, and one-on-one discussions with our clients. We are here to help you communicate with your clients and have created a video link called Barometer Insights, which explains our investment process and disciplined selling strategy. This link can be sent to clients and prospects, and Nick and I are happy to send it over to you. We feel ideally positioned with our leadership approach to adapt and position the portfolio towards securities with pricing power and less interest rate sensitivity. In our view, there continues to be sizable demand for income replacement, with huge bids for income-producing assets we've identified as leaders. With that, we'll open it up to any questions.
We will now begin the question and answer session. If you have a question, please press star, then 1 on your touch-tone phone. If you wish to remove from the queue, please press the pound sign or the hash key. There will be a delay before the first question is announced. If you're using speakerphone, you may need to pick up the handset first before pressing the numbers. Once again, if you have a question, please press star, then 1 on your touch-tone phone. And we have Elliot Baker from BMO online with a question. Please go ahead.
Hi there, Elliot. Hi there. How are you doing over there? Question just about a name specific, Apple, for a U.S. position in the portfolio.
Mm-hmm. So listen, we've avoided Apple now for, I don't know, a year maybe. And realistically, you've got a situation where it grew to its prominent position on great volume gains and margin expansion. And you've got, at this point, a slowdown in growth and real risk to its margins. So, you look at the strategies that they could employ going forward, mass market product at the low end, that's going to hurt margins. Or something really innovative, some new product that comes to market, which is going to be basically a startup in manufacturing, again, a challenge to margins. So we've just found in general when a company goes from one end of the spectrum, not well liked like it was in 2003, to where it got to, a year or 18 months ago, it really has gone through a whole cycle of revaluation. And once it starts going the other way, there's a long way between where momentum investors buy and where value investors really come in. And we've just found that it's very hard to make money in a value technology stock. So I think it's a great company. I love the products. We just can't see having any real exposure to it.
And we have Brian Trayford from CH Financial online with a question. Please go ahead.
Hi, David.
Hi, Brian.
Just very quickly, and you might have commented on this earlier, so I apologize if I missed it. I joined the call a little later. I see a lot of Lifeco names in the portfolio. Could you maybe just comment on that very briefly with your traction of that sector?
So look, we talk a lot about having the flexibility to own things that can benefit in a rising rate environment. And certainly in a rising bond market, one of the two types of companies benefit. One are those with big pension liabilities that have been hurt by low interest rates, and the other are Lifeco's is a good example where they actually really benefit on their obligations as interest rates rise. So rising interest rates and couple that with a weak Canadian dollar, it makes some of the Canadian Lifecos very attractive because a lot of their income's coming out of the U.S. in U.S. dollars, and they're getting the tailwind of rising interest rates. So I'm not saying these are big growth vehicles, but they certainly benefit in this environment. And so we do have, if you look at our Canadian financials exposure outside of some CI that we own in the asset management space, we own Sun Life, we own Manulife, we own IAG, and we own Great West, and that's just a little bit of a tailwind from rising interest rates.
Thank you.
And we have no further questions at this time.
Okay. So listen, we talk at the beginning about being in a volatile environment and all of these things. I have to tell you, we feel very good about where these portfolios are right now. We got great yield support, which are substantial risk premiums in them versus where you could be in a fixed income piece of paper. We got excellent dividend growth in the portfolio. We're highly confident that virtually 100% of our holdings will give us dividend increases in the next year. We have cash in the portfolios that give us opportunity in the event that things get a little floppier. We've got a very strong weight in U.S. dollar-based holdings, and you should know we're holding all of our cash in U.S. dollars because in virtually every case where you have a lower growth rate in Canada than in the U.S. and floppy commodity prices, you get weakness in the Canadian dollar. So we like the fact that we're getting a little bit of sloppiness in these markets right now. It's provided opportunity in the income portfolio for us each of the last 3 years as you went through the summer. And the one thing that I would just highlight to leave you with is that after 22 years of trying to find revaluation themes, when you find one with real legs to it, you know how it works. They rally and then they consolidate, either in time or in price. In every case when they consolidate in real leadership themes, you have an army of people underneath the surface that have been waiting for their opportunity to be buyers. So the downside risk generally is very limited until you get to a point where things get to be extremely volatile. We're not there. So we think that this pullback provides us an opportunity to search out some new opportunities, and I think for our investors, to add to the portfolios, because we see no sign that global growth is about to accelerate and take off, or that there's some great new area of income replacement opportunity that gets presented. So we think there's an underlying bid to this space for quite some time, and picking your spots, I think, is probably the best way to go about it. Anyway, thanks everybody for taking the time. Hopefully you got something interesting to do this evening. And if you've got any questions, give us a call. We're around, happy to talk to you.
Thank you, ladies and gentlemen. This concludes today's conference. Thank you for participating. You may now disconnect.